You've seen the rate. 3.94% 5-year fixed, sitting right there on the screen. Then you apply. And the number that comes back is not that number. That advertised rate wasn't a lie. It just wasn't yours. It was priced for one very specific borrower. And there are 5 numbers that decide how close to that borrower you actually are. Every advertised rate has an owner. Picture them. Credit score comfortably above 700. A down payment that's been sitting in their own account for months. Nothing gifted, nothing borrowed. No car loan, no line of credit, no student debt. Salaried, same employer for years, income easy to verify. Buying a place to live in, not to rent out. That person is real. They're just rare. Everyone else gets priced by how far they sit from that profile. Here's exactly how that distance gets measured. Number 1, your credit score. 680 is the line that matters most in Canadian lending. Above it, you're shopping the best rates the big banks and the monoline lenders offer. Below it, sometimes by a handful of points, your file quietly moves to a different shelf of lenders, priced anywhere from half a point to 2 full points higher. Crossing that line, on a typical 5-year term, is worth roughly $15,000 to $25,000 in interest. Not because you became a worse borrower, because you landed on the wrong side of a threshold nobody told you about. Pull your score before you shop. It's the one factor here you can still change. Number 2, your down payment, because it decides whether your mortgage is insured. Under 20% down, default insurance is mandatory. It's priced in tiers, from about 0.6% of the loan at 65% loan to value, up to about 4% at 95%. Now the counterintuitive part. Insured mortgages often carry the lowest advertised rates, because the lender's risk is covered by the insurer. So the borrower putting 5% down can be quoted a better rate than the borrower putting 25% down. That doesn't make it cheaper. The premium gets added to your principal, and you pay interest on it for the life of the loan. Lower rate, larger balance. 2 different questions, and the ads only answer one. Number 3, your debt ratios. Lenders run 2 of them, not 1. Gross debt service, housing alone. Principal, interest, taxes, heat, capped around 39% of gross income. Total debt service, housing plus every other obligation you carry, car payment, credit cards, student loan, capped around 44. The second one is what usually bites. A strong income carrying a car payment and a couple of balances can qualify for less house than a smaller income carrying nothing at all. It isn't what you earn. It's what's already committed. This is also where amortization becomes a lever. Stretching the loan over more years lowers the monthly payment, which improves both ratios and qualifies you for more. It also means more interest over the life of the loan. That trade is real. Make it deliberately, not by default. Number 4, and this one surprises almost everyone. The rate you qualify at is not the rate you pay. Every federally regulated lender has to test you at your contract rate plus 2%, or 5.25%, whichever is higher. With contract rates well above 4 right now, it's the plus 2 that governs. The 5.25 floor is effectively dormant, so a mortgage costing you 4% has to prove you could carry it at 6. That gap isn't a formality. It's the single biggest reason people qualify for less than their budget suggested. And almost nobody runs that math before they start looking. One important exception, and it changed recently. Everything so far assumes a fresh approval. At Renewal, it works differently, and it works in your favor. Since late 2024, moving your mortgage to a new lender at Renewal is exempt from the stress test, as long as it's a straight switch. Same balance, same remaining amortization, nothing added. That removed the single biggest reason people stayed put. Increase the loan or stretch the amortization, and it becomes a refinance, and the test comes back. But a straight switch, at Renewal, no longer has to clear that bar. Number 5 isn't a number at all. It's who you ask. A bank sells you that bank's mortgages. One shelf, one set of rules, one person you can sit across from. A broker submits your file to many lenders, banks, credit unions, monoline lenders that do nothing but mortgages, and shops it. On a standard approval that typically costs you nothing, the lender pays the broker when the mortgage funds. Neither is automatically better. A wider shelf tends to matter most when a file is complicated. Self-employed income, a thin or bruised credit history, a rental property. A single existing relationship tends to matter most when the file is simple and already sitting at the bank you use. The version that holds up. Get a quote from both and compare the numbers rather than the names. So before you shop a rate, know your own 5 numbers. Your credit score and which side of 680 it sits on. Your down payment and whether that puts you above or below 20%. Both debt ratios, not just the housing one. The rate you'll actually be stress tested at. And one quote from a broker, one from a bank. The headline rate was never a promise. It was one answer, priced for one borrower. These 5 numbers tell you whether that borrower is you. Like, comment, share, and subscribe to Variance for clear explanations of the forces shaping your money and your world. Next, fixed versus variable. Run as actual math on a real balance, so you can see which one wins and under what conditions. This video is general information, not personalized financial advice.